Welcome to another video of Fahad Gohar series, Financial Indicators. This is going to be the video number 2 related to the corporate tax rate. The corporate tax rate is a crucial financial indicator that is directly impact businesses, government revenue, and the overall economy. It is the percentage of a corporate profit that must be paid to the government as taxes. Corporate taxes are key revenue sources for government. Changes in the tax rate directly influence public spending and infrastructure investment and social services and debt repayment. Government usually may adjust corporate taxes rate to achieve economic policy objectives such as stimulating growth or encouraging investment or addressing a physical defect. So now let's find out how we categorize this, corporate taxes. The first level will be, of course, low. Generally anything below 20%, this range is typically considered a business friendly. It's encouraging investment and expansion. Now we have the moderate. The moderate, it's between 20 and 30%. This is seen, of course, as a balanced approach. It aims to collect fair amount of taxes for the government as a revenue while still promoting a healthy business environment. Then you have the high rate. Anything above 30% is considered a high tax rate and may indicate a government focus on public spending or income redistribution, like building bridges, free health care. But they can also discourage businesses and investment and potentially slow economic growth, because a lot of companies will not like to be investing their money in a country that has a high tax rate for corporate. So now let's see how we can see the effect of that tax, the corporate tax rate, at two levels, at the low level and the high level. At the low level, we're going to start first how it affects the market confidence. Lower corporate tax rate are generally viewed as a positive by investors. It boosts the market confidence as companies anticipate, of course, higher corporate revenue, because a bunch of their taxes revenue is kept from being paid as a taxes. Will make their gain higher, and the future potential will be an economic growth for them. So market confidence will go up. How about government debt? Of course, low corporate tax means less money collected by the government, which may increase its deficit, especially if that government does not offset the revenue losses with cuts in overspending. So the government debt will go up. How about the interest rate? What's going to happen to it? Of course, low corporate tax will stimulate economic growth and will increase demand for more borrowing. More borrowing. This increased demand of more borrowing can push the interest rate upward by lenders, because now they are greedy. They want to get as much as possible out of you. So interest rate will go up. How about then the bonds? What's going to happen to it? Low corporate tax rate will lead to a lower tax revenue for the government, which might lead that government to increase borrowing. How? By issuing more bonds to cover up its needs, with higher taxes, of course, with higher bond yield. What's going to happen? Now the new bond will gain, value because their yield is higher, but the older bond will become unattractive. But the new bond will be going in their prices higher. Okay, now let's go for what's going to happen to the corporate earning then. low corporate tax, earning for corporation will increase, of course, because a big chunk of their sales and revenue it's kept, which can result in a higher dividend for the shareholders and more fund available for reinvestment and improved financial ratio. That means corporate earning will go up. How about product pricing? Of course, low corporate tax will allow companies to lower prices for their product and also invest in quality improvement in production to meet consumer needs and satisfaction. So what's going to happen to the product pricing? It's going to go down. How about employment? What's going to happen to it? Of course, the low corporate tax will lead to a business expansion, potentially creating more jobs and cash availability, and that will boost consumer spending. So companies need to expand, need more employees, so employment will go up. How about the stock prices? What's going to happen to it? With a low corporate tax, that will lead to higher stock prices, as companies are reporting now increased revenue and profit, so stock price will go up. How about then the effect on inflation? Of course, company will reduce prices and invest in cost saving innovation, which will lower taxes, also may increase and stimulate economic activity. So inflation at that point, what's going to happen to it? It's going to go down. Now let's see what's going to happen for the currency. Of course, a low corporate tax rate will attract foreign investment, which will increase demand for that currency, and potentially will lead to an appreciation of the value of that currency. So the currency value will go up. Now let's look the other side. When the high corporate tax is there, what's going to happen to those elements? We'll start first with the market confidence. Of course, high corporate tax, may dampen investors, and their enthusiasm, especially in sectors heavily reliant on profit margin. So the market confidence will go down. How about the corporate earning? What's going to happen to it? Of course, with the high corporate tax, will directly reduce a company revenue, because big chunks of their revenue is going to be paid as taxes, and their net income will be much lower. So the corporate earning will go down. How about inflation? Of course, a high corporate tax rate, will lead to increased product prices, as company, of course, will pass, the cost of those taxes to the customer. They will add that cost to their product that they are selling to the customers. So what's going to happen? The taxes will be passed to the consumer in terms of higher goods prices, which of course contribute what? It's gonna result in inflation in those product prices. So inflation will go up. How about bonds? What's going to happen to the bonds? Of course, will increase government revenue, because now the government is collecting more taxes, and so what's going to happen? And that will reduce the government, needs to borrow from investors. How it borrows? By issuing, of course, new bonds. Government doesn't need to issue new bonds, so government existing and new bond will have lower yields, because the government is not forced to issue new bond with higher taxes to attract higher interest rate to attract investors. It already have enough money from the sale tax and the income tax that it collects. So the bond yield will go down. How about then the interest rate? What's going to happen to it? Of course, high corporate tax might slow economic growth by business, of course. Potentially will lead to what? To lower interest rate due to reduced borrowing demands by the businesses and the consumer. So for the banks to attract consumers, and grease up the economy and make it move forward, it will lower its interest rate, to let more money available for the consumer, so the interest rate will go down. How about the product pricing? What's going to happen to it? Higher corporate tax can lead to increased prices of goods and services, as company pass on the tax burden to consumer. So product pricing will go up. How about government debt? With a higher, of course, corporate tax will provide more government revenue, will potentially, of course, reduce the budget deficit and national debt, and make the government manage or reduce all other debt level. So the debt level will go down. How about the stocks? What's going to happen to it? Of course, we know that it will decrease profit from companies. Potentially, what will do what? Will lead to downturn in stock market performance, because companies are not investing, because they know the more they invest, the more taxes they will end up paying. So stock prices will go down. How about employment? What's going to happen to it? High taxes may, have the opposite effect, potentially leading to layoff or reduce hiring by companies. And now, finally, what's going to be the effect on the currency value? It might deter, of course, foreign investment, potentially will weaken that currency of that country. So the currency value will go down. So this is now here, a view side by side, just for your own entertainment and for easy comparison. Now we're going to address some charts, like the stock market index versus corporate tax rate. As you see, corporate tax rate, as you increase the tax rate, what's going to happen to the stock market index? Of course, it will go down, because companies are losing money. A lot of chunk of their money, instead of being used for expansion, for new product or improvement, end up paid as taxes. So now, how about the corporate earning versus corporate tax? Corporate earning, of course, we know as the corporate, pay more taxes, as you can see, as taxes goes up, the corporate earning goes down, and that's also will be reflected on stocks, as we just explained earlier. How about now, the government revenue? Here it's the kick. Of course, more tax, corporate tax rate, more money for the government to spend in any project it needs, or pay its debt, or manage its own debt. So now, I hope this one was very helpful in you, to educate you about the corporate tax rate and how is it used as a financial indicator in the market. See you in the next video.